If I can ask our next panel to make their way to the stage, please. So, I mean, we all know last year or so there's been pretty awful returns from equities. There's been even bad returns from bonds at the same time, which is probably an unusual thing. So people have been starting to look for other opportunities, including illiquid investments, and our next session is going to look at just that. The moderator for this session is Francis Taylor. Francis is the Head of Investments and Managed Portfolios at AMP. Please welcome Francis and the panel. Thank you.
Always vertically challenged. Welcome to the second session of the day. I am the moderator. The moderator's job is to hand over to far more important, intelligent people than yourself, which is what I'm going to do here. On the panel today we have Rob De Silva from SQM Research, Dale Holmes from Spire Capital and Rebecca Jacques from Mercer. We are going to talk through private equity, private debt, real estate, hedge funds, how that fits into a managed portfolio, and they will cover different aspects of that. We'll probably let them speak and then at the end throw it open to yourselves. We want a lot of questions on this topic, so yeah, enjoy the session and we'll have Rob up first.
Liquidity, return, volatility of alternative assets. I'm not going to go through, there's 36 different options there, I'm not going to go through every one of them. But I will pick out a couple and just talk to them in general. So private equity, you know, we all know that the liquidity there is challenging, and I think, you know, most people would agree it's illiquid. The return profile is high, and, you know, to be frank, across the alternatives sector, and particularly these less liquid classes, the return profile tends to be medium to high. Otherwise, why would you invest in illiquid assets if there's not some kind of attraction to them? So it's not surprising that you expect to see something reasonable coming out of that. And the volatility element, so if you look at that volatility column, it's kind of a mixture of two types of volatility. We've got economic volatility. Is this asset class subject to movement in its economics relative to the rest of the economy? And the answer is, well, everything is, right? The economy affects everything. So private equity, the valuations and the cash flows of the businesses that they own are going to be related to the economic fortunes in some degree. But the prices of those assets don't necessarily react in the same way or to the same extent. So there's a sort of disconnect in a lot of these to varying degrees. Some of them are much more closely connected, so precious metal ETFs will be much more closely connected, direct precious metal funds, etc., long-short equities, and so on and so forth. So in these last few years, private equity and private debt have become quite popular. We've seen ourselves more demand for rating private credit product, and a lot of those tend to be real estate lending of various forms. But again, over the sort of more recent period, we've seen more corporate lending products coming out, small to medium enterprise lending, and that's been partly driven by banks kind of pulling away from that market themselves and therefore opening up opportunities to other specialised firms who often are ex-bankers or come from a credit background of some sort. And that's an interesting opportunity because the yields there are quite decent. The liquidity is low because these tend to be, you know, not cash style at call accounts. They're going to be loans from anywhere from a few months to a few years, and the volatility will be low because the duration is typically pretty low. So, you know, there's then we also have quite liquid alternative assets like managed futures, systematic strategies, risk premium strategies, etc., etc. Sometimes there's leverage involved in those, and that can affect the volatility quite dramatically. So there's a whole, there's as you can see, it's not a simple, the umbrella term alternative assets has a lot of detail under the hood and very many differences across those elements, which is why a little bit of work is involved in trying to understand the various products that you might be faced with under that one kind of, umbrella. So, what have I done here? Hang on, sorry. There we go. All right. So, in terms of liquidity, one other aspect I'd like to sort of just mention is that funds that have a mixture of illiquid assets and possibly some liquid assets, their ability to meet redemptions and the so-called perceived liquidity will be partially dependent on whether they're in inflows or outflows. If you've got a sort of, new fund growing quickly, they're not going to be as challenged in providing liquidity to clients because they can fund redemptions out of applications. And so newer funds that are growing quickly are popular, blah, blah, blah. They tend to be almost regardless of what the assets are like. They have the more ability to provide, to a degree, obviously, redemptions. Whereas if it's a fund that's in decline for whatever reason, that is a hell of a lot more challenging and you've got a much higher risk of gating. So that's something also to keep in mind. So as I said, you can't, if you look at, say, Aussie large cap equities, you could probably draw a broad conclusion that most of those funds are pretty liquid. If you say alternative assets, you can't say that. You've got to look at every fund individually and figure out what's going on there to try and to determine how much liquidity there really is. And you can make some broad assumptions about particular categories like direct property or direct infrastructure, etc. But even there, you've got to look at the detail because there's different levels of liquidity and accessibility within direct property and infrastructure and so on and so forth. So, some funds that might look liquid to you on the outside can in fact have lower liquidity, and that varies over time too. Some assets have a period of popularity, like private equity was all the rage for a period of time. In those periods, liquidity can be quite high because there's a lot more activity in the assets underlying them. So as we have market cycles, the liquidity has a cycle of its own, even in illiquid assets. So there'll be easier times to sell and buy and tougher times to sell and buy. And that is something that, you need to take account of. Hybrid oriented funds, which are a mixture, you can have a lot of, perceived liquidity, but still get gated, even if a fund isn't in distress. Because some funds will have rules of, like, we have a limitation of 5% of redemptions per quarter or whatever it might be. So it's possible to find yourself being gated even if a fund isn't, strictly in distress or anything like that. So again, devil's in the details. Different funds have liquidity windows of varying types with varying conditions and restrictions. So you need to know what the exit strategy is in those individual funds. And I think this is where research, whether it's us or other firms, can provide some information to investors that's useful, because it's these sort of under the hood. These details are not on the front page of a PDS, I can tell you that. You've got to dig around and ask questions to get the information. And so, having other people doing that kind of work can be helpful. Shameless plug. The return profile, as I mentioned, can be different across those asset classes, particularly in the hedge fund world, where leverage can play a big impact both on the positive and the negative side. And again, sort of picking on sort of risk and return differences. With taking mortgage funds, for example, you can have low risk, low return mortgages. You can have high risk, high return mortgage funds, depending on what types of loans and where they are in the capital structure and the risk structure as well. So how am I doing? I've got 7 minutes. I think I'm close to time. Okay. I'll just read this out. Be wary of low liquidity funds masquerading as low volatility funds. I think I already said that. You know that. Just pricing everything once a year doesn't mean it's low volatility, right? So these funds have economic volatility if they don't have price volatility. And so just because they're not being priced day to day doesn't mean there's not risk. And of course, the key thing is valuations. Frequent and independent valuations are very important if you're going to have a good handle on what you're looking at. And what's interesting in the private equity world is that you can have the same company valued at very different valuations across different investor portfolios because they're doing their own valuations. You don't have that in the public markets because BHP is worth $10 for everybody, but WeWork might be worth a lot of different dollars in various portfolios. So that's another thing to, be careful of. There you go. Thank you.
Hi, good morning. My name's Dale Holmes. I'm from Spire Capital. Great to be here with you this morning. I concur with a lot of what Rob said, and I'll probably just put a little bit of a different spin on it. But I've been involved in the industry for over 30 years and was an advisor myself. And the interesting thing, I think we're in the same game. Everyone in this room is trying to build robust, reliable portfolios that deliver a return outcome within a risk parameter that allows us to reliably deliver our clients to their lifestyle. So we're all trying to achieve the same thing. It's a question of how we put that together, and there's different ways to do that. And so today's discussion is, what are we starting to see in the wealth market as we're starting to see what was institutional start to come down into wealth. And we'll talk a little bit about the new evolution of some products that are coming to the market that allow private investors through private wealth to get access to private markets. And that evolution is accelerating at great pace, and everyone will start to see more and more opportunities come your way for private markets. The question is whether you see it fit within an environment like a managed account, or whether it sits as a satellite to the managed account, and how can that be reported on, administered easily so it's efficient for you as a business owner to deliver and report back to your clients. A little bit about Spire as a way of introduction, because I don't think too many people in this room would know who Spire is. So Spire Capital, we've been around since 2009. It's a private business based here in Sydney. Effectively, our business model is to partner with global partners. We have 11 global partners in private markets only. We don't do anything in the listed market. We think the listed market's well covered by everyone else that is doing traditional asset classes. And so, over the course of time, we believe that there is a morphing together of what was institutional and what was, if you like, private wealth, and that'll come together, and we're starting to see that occur. And we're trying to enable that by creating access to private markets across private equity, venture capital, real estate, infrastructure, real asset strategies, hedge funds and the like. So our game plan, we have 75 family offices here in Australia that have used us in some shape or form, and about 50 wealth advice groups as well, who see the virtue of private markets as part of their offer to clients. And as advisors, you're best placed to work out where that fit is in terms of liquidity, in terms of vol, in terms of the way you want to try and find ways to diversify risk. I saw a good message come out by Grant Patterson, who is the chairman of the investment committee at Providence Wealth, which is a high quality advice firm. And Grant talked about the 3 Ds that are ever more important right now, and that is diligence. So to Rob's point, having the ability to pick up the bonnet and see what's in the engine. Diversification, it's a cliche, but it's never been more important than it is right now, and to understand truly what is diversified. And the points around correlation that Rob talked to are absolutely real and never been more real than they are as we sit here today, especially after the weekend. And then the discipline that you bring as advisors with your clients to be able to keep through that journey, to stay that journey. It is a little bit about the painful 1,000-kilometre bike ride that I know our friend here is embarking on this Friday. I think the next journey, the next 10 years is probably going to be somewhat different to what we've experienced over the last 30. We've had an incredible run. We've had easy money, and now true diversification is going to be critically important. So I think, having opportunities to get access to alternatives, be they liquid or illiquid, and how they fit into your portfolio construct is critical. And our industry has to create the solutions for that, make it easy to access, have it on reporting platforms, have it structured the right way. So in terms of, the concept around opportunities for private markets, alternatives, illiquids within a managed account environment, just for context, we have groups who've used us to buy episodically a product. They might like an opportunistic theme, or they might like a mega trend, and they buy, one of our products. There's other groups that ask us to create an access feeder vehicle for them to get access into a deal that they really like, and we're just the administrator of that opportunity. And then there's other groups that use us as a total private markets program, where we're building out a portfolio and implementing that portfolio in private markets, because they want to have it in a construct that is packaged, implemented, and managed and reported on in an easy way, just like a managed account. It acts as a satellite. We have had large groups that have used some of our semi-liquid private market strategies within their managed account portfolios. Different groups are able to facilitate that. They're happy to put up with some operational challenge for the pursuit of the integrity of the portfolio construction. So there's horses for courses. There's no right or wrong way. Your firm will have your own views and philosophies on that. So in terms of just the sort of discussion points, this is a little bit to what Rob just spoke to. He's got a better slide than mine, but it basically tells the same story. And that is that, you can get access to the building blocks for portfolio construction at the very liquid end. And with that, you get great liquidity, but you have obviously all the things that go with liquidity, and that is sentiment and volatility. And at the other end, you can have incredibly illiquid stuff that takes time and patient capital, but there should be a return upside. Otherwise, why would you lock it up? And so across that continuum, across, equity, fixed income, and real assets, all those building blocks exist in the market and continue to become more accessible for private wealth. You're going to see some of the brand names that you don't necessarily get a lot of exposure to because they've typically been the domain of the institutional investors and the sovereign wealth funds. But you're going to see the KKRs and the Blackstones and the Oak Trees and the Brookfields of these groups who perhaps have always been, sourcing their capital from the institutional market. They're coming down into wealth. They're building products. You're going to get access to those products. They're going to have forms of liquidity, and you do need to understand what that means in terms of the real liquidity that sits within those product constructs, but they may be appropriate as part of a diversifier within your portfolios. And the question around liquidity and volatility is an interesting debate. With your role with strong leadership and advice to your clients, you will know your clients' liquidity needs. You will know that you want sometimes to have episodic liquidity where you can get access to something, but in reality, the trade-offs of having fully liquid portfolios is sometimes you get incredible drawdowns because of sentiment and that volatility, and whiplash can be painful for you and your clients. Another conversation, putting out a fire about something that the market, you have no control over. So I think, the conversation around liquidity and volatility and the way portfolios are constructed and your leadership and your ability to sit with clients and help them on their journey to deliver the future cash flows to meet their future liabilities is essentially the role of advice. Why do we think they're really complementary? So I might be up here talking my shop about private markets, but in reality, what I'm saying is there is a role for private markets within portfolio constructs. And if we get access to them in a way that's easy for you to administer and report on and advise on, and you feel like the integrity of the underlying investments are high quality, then there's a role for them to complement public markets. And they should give you a return profile that is enhanced, because it's just not as easy to get access to some of these opportunities. It's, the sort of information flow, the amount of active asset management that's required in a private equity investment or a real estate investment or infrastructure investment is something that should give you a return enhancement through the private market, because it's far less efficient than the listed market. The obvious example that everyone references is the Future Fund, and you can see how incredibly diversified they are. And if you actually clicked on every box within private equity, infrastructure, real assets, you're going to see an incredible level of diversification, and I think some science behind why they allocate the way they allocate. They might have a view that, you know, sort of small mid-cap PE is a better place to play than large-cap PE. They might have a view that active management in infrastructure in a higher interest rate environment is a better way to go than having a core long-term hold position in infrastructure. So basically, you know, getting access to some of the highest quality managers, because the dispersion of returns in private markets is far greater than the public markets. You do have the winners and the losers. It's a far more significant dispersion of returns, and so therefore you do need research. You do need to have you know, access to information that allows you to make decisions on those managers that are going to deliver that enhanced return. And there should be that trade-off we talk about, which effectively showcases, you know, that the returns from more illiquid and private investments over time should give you some return over and above the listed market. And the last point before I hand back to Rebecca is this is an interesting case study in point. I just use this because this is a real case study. It's a case study when COVID hit. We actually the first speaker who talked about the rents and the rental market in the US. We invest heavily in that space. We have 110,000 apartments, 150,000 renters in the US. And essentially what happened in COVID was that orange line essentially was the private market. The blue line was the public market. It was exactly the same asset class and sector. Effectively what we saw is a 45% drawdown through COVID. But bizarrely, what we saw was occupancy going up and rents going up. So what that blue line is sentiment. That's the volatility that kicks in because of sentiment. All the underlying fundamentals should suggest the orange line was what actually was being delivered, but sentiment took over and the blue line is what people experienced. That difference between that orange and blue line is the sort of noise that we get caught up in through the listed market. So just a reason why we played the private markets in certain sectors rather than the listed market. We think there's great ways to get access to that now. A lot of our stuff is available on platforms. There's going to be great managers in the private markets that'll be knocking on your door, talking about private investments and having semi-liquid strategies where it be maybe monthly or quarterly liquid. And Rob's points are well made around the integrity of the valuation process. You want to be associated with managers who the best investors in the world are investing with. So look, just food for thought. Great to be here. Thanks so much to IMAP for having us, Toby. Thank you again, and look forward to the questions. Thanks, Rebecca.
Okay, so the great joy of being last is that I don't have to repeat what everybody else has said, because there's only so much we can talk about when it comes to diversifying alts. Just as everybody has reiterated, just so that you're aware, at Mercer, we are the same, right? When we look at alternatives, they're not a one bucket sort of catch-all that fits everything. And it does break it down into obviously the private markets, real assets, and then also some of the more liquid assets that many of you would probably be already familiar with, such as liquid alts and diversified alts. The real issue is, and we can go through this, but it's essentially what everybody's talked about. You're really playing in these asset classes because of the fact that they're going to give you a better return profile and also a very different risk profile. So the points that both Dale and Rob have made are that the volatility might be one measure that you focus on, because that's obviously what we see a lot when we're dealing with listed markets. But the reality of it is they bring slightly different risks to the table. They tend to be exposed to different sectors, which is one of the reasons why you invest in them, right? Particularly when you're looking at private markets. There's an awful lot of things on these charts as to the differences of how they prepare, when you compare and contrast. And these are all factors that you have to consider, right, when you're looking at how they fit in a portfolio and who do they suit. Because yes, they might offer you great return profiles, if you can get the right ones, but they do have a different volatility profile, right? They do have a different valuation profile. And so therefore you need to understand how that fits into a total portfolio and which clients it's actually going to suit. So, you know, we spend a lot of time working particularly on the managed account side, and some of this stuff we don't use in like retirement portfolios. Now, naturally, most people would immediately go, well, why not? It's a long-term, you know, you're still investing for 20 years, you know, typically. They're not sort of, you know, a 10-year sort of horizon. And the real reason is to do with the fact that what do they actually need out of the portfolio? And a lot of it is to do with income that's coming out. Now, that's not to say that these assets don't pay income. It's just that the nature of how they pay it and some of the sort of gates and things that can come into it. I'm not going to go through all of these sort of slides. It goes on and on and on. You know, I think everybody here knows why we invest in these asset classes. You know, I would sort of talk about just a little bit, you know, you heard Bob this morning talking about the changing economic environment, some of the fundamentals. And, you know, Dale's touched on it, so's Rob touched on it. You know, the future environment we're going into is going to be vastly different, right, from where we've been, particularly from, you know, even if we believe those inflationary pressures are starting to subside, we're probably still a long way from that sort of benign sort of, you know, 2% sort of sitting around that level. And, excuse me, and so it's really about how you incorporate, you know, different return drivers, different risk drivers into your portfolio. And that plays out in also, if you think about the ESG sort of space, I must be careful, I'm not meant to talk about ESG, so I don't know why I raised that. You know, but I mean, as you would know, you know, a lot of these sort of innovative sort of markets typically are not in the public or listed space, right? They tend to be much more in private sort of arenas and, you know, it enables you to capture some of the opportunity set that's coming forward. I know most people have focused it very much on just taking things out of portfolios from an exclusion perspective, but there is actually an opportunity set going forward. And lastly, what I do sort of want to leave you with is this all goes through how it impacts through inflation. But effectively, this is why we focus on it, right? Because it's really about shifting that efficient frontier slightly up, you know, without necessarily changing the overall volatility of the portfolio, but be cognizant of the fact that what you're actually taking on is slightly different risk drivers, right? So your efficient frontier doesn't necessarily always capture all those risks, which is why these pictures look fantastic, but then we all hear sort of the horror stories of gates closing or, you know, what's going on at the moment where things collapse because of sort of loopholes and what have you. So I'm going to leave it there because I think the real challenge really is about how do you actually get this stuff into managed accounts and portfolios, because we haven't solved for that yet.
Yes, I must admit, you know, like when an advice group and an asset consulting firm come to me and they say we're building a portfolio and it's got this really illiquid asset in it, my face sort of looks a bit dropped. And then it is a matter of, as Rob said, actually going through and saying, well, what is this particular fund doing? How is it priced? Is it monthly? How can we incorporate that into the portfolio, into the reporting? And is there any operational issues that we need to go through together with the consultant and the practice to understand, well, okay, these are the limitations that we'll have to manage through as a platform or as a managed portfolio provider. But I think it is, as Rob said, the devil's is in the detail on the fund that you want to use and its role within the portfolio. And I think, Dale, you've had experience with particularly building out with some of the wealth groups and also Beck. So, I mean, you might talk from your perspective in terms of the high net wealth clients in that area.
Yeah, I think there's the advice piece, there's the implementation, and then there's the execution on a platform. And so, you know, our job is to go through a process where, you know, a research group's going to look at our deal flow, there's research done on it, we can take it to an advice group and talk about the merits of that opportunity, but obviously the advice group needs it to be implemented in a way that's on platform, reported on, and it may sit within a managed account, may sit alongside the managed account in a platform, not all managed accounts are the same, obviously. You've got some that have more discretion. And then you have some groups who've moved even towards a unitised fund to be able to have more illiquids in their strategy so they can meet cash flow requirements from more cash-like investments. So they're trying to, I suppose, liability match through their unitised fund, and they'll have ranges of allocations through that. So there'll be different ways that people think about private markets being implemented into their portfolio. Even at the platform level, you know, groups like we found Net Wealth and, you know, Net Wealth Now, you know, Premium and the likes, they've even moved to the next phase where they're happy to do progressive call structures rather than fully called structures. So there's evolution because of technology that is starting to make these private market opportunities more accessible. And then we have traditional platforms that have taken, you know, some have got very different views about, they want no liquidity in some cases. They want the products to be illiquid. And in other cases, there's other groups that want it liquid. And so it's horses for courses even at the platform level. Yeah. And you've got to work through all that.
Yes, you do. Different platforms offer different things, but even the groups that within a platform, they're surrounded by a greater corporate structure where they may have custody themselves, and so can look to that illiquid, totally illiquid, and use that as a reason to mix that into the fold. Or you're using the platform account in parallel to the managed portfolio, and then reporting in totality on the top of the assets. So there are different ways you can manage it, but I think it's exciting because this sort of thing does push the technology and does push platforms to actually develop different ways to incorporate it. So it is less clunky, but you know, it has been clunky in the past, but it's also the appetite, and it comes clearly back to the appetite of the client and the practice in how they'll interact if something goes bump. Any questions from the floor? No.
I've got a question for both, I guess, Rebecca and for you in your role, Francey, which is the issue of the insistence of the portfolio managers or the platforms, as the case may be, on valuation methodology within the fund. Both Dale and Rob referred to this. So what are your expectations as either portfolio managers or platforms on how funds treat valuations?
Look, platforms are a beast of data feeds, and we love daily liquidity, daily pricing, but that, you know, then we move into monthly and then we move to quarterly. But as Dale has indicated, there's always clunkiness to that, bringing that back into the reporting for the client on their transaction reports and on their, you know, reports themselves on the performance of the portfolio, because you're dealing with a valuation that for that particular asset is dated, and you have to catch up when that month or that quarter valuation comes in to incorporate that into the reporting. So it's just understanding, I suppose, those issues and how it will affect reporting or how it will affect.
I was really thinking about it in the context of the process that the manager uses to value what are essentially illiquid or private assets within the fund. Rebecca, do you have a sort of set of expectations?
Yeah, look, I mean, we obviously incorporate across a range of clients, you know, private markets. The real perspective is the independence, right? When there's valuations involved. We're not as concerned by the lag, subject to exactly what Francey's talking about, how it then is dealt with at the reporting level, and also the client's understanding of that. But yeah, I mean, the biggest sort of issue I think everybody comes to is the fact that, you know, the valuation itself has to be solid. It also has to be independent, and it also has to be verified, right? So, and, you know, I don't think private markets are particularly any different to public markets in the sense that, you know, we need the data providers to get it right and feed it through effectively, right? You know, we still spend copious amounts of our time actually fixing publicly listed data still feeds because, you know, when distributions come through, they get missed or, all sorts of sort of... So I don't particularly see private markets as a unique set of data issues, other than that you do need to make sure that, they genuinely have independent valuation. And you also, the only thing we would state on it is you don't want those sorts of things to be changing, right? So, if they're changing providers of how they're getting assets valued, that's just part of the sort of standard red flags that you would immediately look at and go, well, why is that the case? Is it because they didn't like the number that came through and so we've got to find somebody else, And, Rob highlighted that when, the same asset in a different portfolio can be vastly different in price, right? So they're the sorts of things that you've got to be aware of and that you're looking at as well. So it is very much, I suppose, Toby, to sort of just conclude it will always be the devil in the detail, right? And you really do have to get into the detail on the valuations themselves.
That's right.
Here's 2 words to watch out for. Director's valuation.
And there should be industry standards around what valuation methodology is used, and there should be independence in the valuation process. And you should get deep into the institutional due diligence questionnaire to understand those things, and you should understand who the other limited partners or investors are in the deal, because typically you won't see the quality into the market involved in anything that doesn't have integrity in terms of that, into that valuation process and the independent sign off of it.
And look, your REs and your trustees are going to actually dictate that that people like Rob have given the particular offer a colonoscopy, for want of a better word, and that there's confidence in the actual product itself and the design of the product in terms of how it's structured with the gating. So there's going to be a certain risk appetite applied, and it'll flow from trustee through to how's your risk appetite in your discussion with your client.
I've got a question, if I may, on the investor sort of attitude to alternatives and whether you've got any tips on this perspective. Talking to advisors a fair bit about these sorts of assets, one of the things that seems to colour their thinking is that they have trouble getting confidence in investors' tolerance of illiquidity, that people say, yep, I'm up for it, and then when it's not there, it makes them very nervous because it almost, they connect in their minds that there's something wrong if I can't get my money out, so it's the transitory nature of the investor's confidence or their commitment to bear the illiquidity that makes advisors nervous. Do you have any, A, is that something you've witnessed in your experience? Do you think that's a real thing? And B, if so, do you have any tips on how advisors deal with that issue to try and make sure that, investors have a happy journey?
Yeah, I see a lot of advice firms move to a liability matching approach where they sit with their clients to understand their sort of 0 to 3, 3 to 7, 7+ timelines, model that into their portfolio, into the cash flows and the plan, and then start to allocate the 7-year plus money to private markets with levels of illiquidity. In the 3 to 7 year buckets, they may have semi-liquid stuff, and have a strong conversation about what actually happens in reality when the markets go against you and people want to grab their money out. But I suppose the reason you go through the process is if you see the trade-off where there's an opportunity for a longer dated patient capital return, then you're prepared to lock it up. But in the advice process, I see that bucket liability matching approach has been used a lot with some of the firms that want to get their clients to commit to a longer term strategy.
Thank you.
Yeah, Brett, I might just add that, the one thing, this is exactly how people typically, make that sort of strategic allocation towards private markets. The only thing that we notice considerably is those advisors that constantly keep the communication up are the ones that succeed, right? So, not just around the actual private markets investment themselves, but around, do you really need the liquidity? We've allocated this money, and so it's less around a return conversation. It's a lot around, cash flow management, liability matching, what can be postponed, those sorts of things.
And Brett, I should have just added, there's one other thing I see in advice firms now is there's a real focus around legacy and philanthropy and having purpose around what that 7-year plus money's about, and might be very dedicated to certain objectives, which might be, intergenerational transfer of wealth, it might be kids' education, there could be any amount of purpose.
And possibly less of a hard end date. Is that what you're suggesting there?
Yeah, I think that it's sort of dedicated to money that is not required for the first 7 years in their life to fund their more shorter, medium-term income requirements, and then ultimately they can then be more patient with that capital and have a dedicated purpose for it.
Thanks, that's very helpful. Thanks.
All right, thank you. My main job for the day is to keep us on time, so please thank Francey and the panel for this session.